Hello everyone, my name is Halia. Today we will be discussing about convertibles, exchangeables, and warrants. There are 5 main topics in this chapter. There are convertible securities, use of convertible, value of convertible securities, exchangeable bonds, and warrants.
Before we go further, we need to know what derivative security is. Derivative securities is a financial instrument whose value derived in part from the value and characteristic of one or more underlying asset, interest rate, exchange rate, or indices. An example of derivative securities is a convertible bonds. The value of convertible bonds depends upon the value of the underlying stock, and thus it is a derivative securities.
Moving on, what is convertible security? Convertible security is a bond or a private stock that is convertible into a specified number of shares of common stock at the option of the holder. This provides the convertible holder a fixed return, interest or dividend, and the option to exchange a bond or private stock for common stock. The option allows the company to sell the convertible securities at a lower yield than it will have to pay on a straight bond or private stock issues. The most common type of convertible securities are convertible bonds and convertible preferred shares, which can be converted to common stock.
The conversion price refers to the price at which convertible securities like corporate bonds or private shares is converted into common stock. It is equal to the face value of the convertible securities divided by the conversion ratio. While the conversion ratio indicates the number of shares of common stock for which a convertible securities can be exchanged, it is equal to the face value of the convertible securities divided by the conversion price.
Anti-dilution provisions, or also known as the anti-dilution clause, are clauses built into convertible preferred stock to help shield investors from their investment potentially losing value. Dilutions can occur when the percentage of an owner's stakes in a company decreases because of an increase in the total number of shares outstanding.
The term conversion value refers to the amount an investor would receive if a convertible securities were changed into a common stock. It is equals to conversion ratio times the current market price per share of the common stock. A premium over conversion value is an amount by which the price of convertible securities exceeds the current market value of the common stock, into which it may be converted.
Other issue with convertible securities, virtually all convertible securities provide for a call price, which allows a company to force conversion when the security market value is significantly above the call price. Almost all of the convertible bond issues are subordinated to other creditors, which allows the lender to treat convertibles as a part of equity base when evaluating the financial conditions of the issuer. The potential dilution effect is recognized by investors who evaluate earnings based on a diluted earnings per share.
The use of convertible securities, in many cases, convertible securities are employed as deferred common stock financing, does not immediately dilute earnings. Securities are converted at a higher price than if they would have been directly issued. This has the impact of reducing the dilution effect. The interest or dividend rate is likely to be less than that of straight debt or preferred stock. The greater the growth prospects of the firm's common stock, the lower the stated rate the firm will need to pay.
The date of conversion may be determined at the outset, left for investor decide, or be at a company discretion. Occasionally, deferred equity will be issued with a call provision, meaning the company can force the investor convert the security into common stock, usually when the stock price rallies to a high level.
Next, what is straight bond value and why is it important? Straight bond value is the value of non-convertible bonds with the same coupon rate, maturity, and default risk as the convertible bond. It represents a floor or minimum below in which the convertible value will not fall. This occurs when the convertible option value is essentially worthless. The straight bond value is subject to change as the interest rates, firm risk, and time change. This in turn is likely to impact the convertible bonds as well.
Moving forward, what is an exchangeable bond? Exchangeable bond is a bond that allows the holder to exchange the security for common stock of another company, one in which the bond issuer has an ownership interest. This issue usually occurs when the issuer owns common stock in the company in which the bonds can be exchanged. Exchange requests are satisfied either by open market purchases or directly using the firm investment holding of the other company's stocks.
Investor may realize diversification benefits since the bond and the common stock are from different companies. Essentially, diversification leads to a higher valuation for the exchangeable versus the convertible. A major disadvantage is that the difference between the cost of the bond and the market value of the exchange common stock at the time of exchange is treated as a capital gain. A convertible gain is not recognized until the common stock is sold.
And last but not least, what is warrant? A warrant is a security that entitles the holder to buy and sell stock, typically the stock of the issuing company, at a fixed price called the exercise price. The warrant contains provisions for the number of shares that can be purchased per warrant, the price at which the warrant can be exercised, and the warrant expiration date. Warrant holders are not entitled to any dividends, nor do they have any voting powers. The exercise price is adjusted for any common stock dividends and splits.
The market value of a warrant are equals or exceeds the theoretical value of the warrant. The greater market value is generated by the unlimited upside potential of the stock price combined with the limited downside risk to the warrant holder, or minimum value is 0. The greater the time to the expiration, the greater opportunities to the upside potential of the stock and the greater market value of the warrant.
And that ends for our explanation for chapter 9 about convertible, exchangeables, and warrants. We hope it will be useful for you guys. Thank you!